Okay, so for example, let's look back at beginning of 2022. So the beginning of 2022, we had, from 2021 leading up to 2022. We all know what happened in 2020, right? And we all know the response that the government from the Federal Reserve and the fiscal spending, we all know the impact that had on the economy. There was a lot of money thrown at this problem. All of that money forced a lot of prices to increase very quickly. And one of those prices that increased very quickly was stock prices. Stock prices was actually just taken off before. Think about it. Stocks and the price of stocks took off before the price of all these goods and services. So when that happened, we started to see the stock market found itself in a situation where, it's like the emperor has no clothes on, right? The stock market looked around and said, oh crap, I came way too high, way too fast.
You are going to get left behind in this economy because your finances are not well positioned. My name is Khayri. I'm here to expose the right way for retail traders and investors like you and me to approach financial markets. So before you start day trading or buying financial products, you need to understand certain principles to ensure you're well positioned to build wealth over the long term. This is how a really good trader is formed, by trading with a purpose and a more significant objective. So, do you want to learn how to construct the best wealth building portfolio? Then I suggest you click the link in the description to purchase my book, One Small Tweak. This book will expose precisely what products go into our foundational portfolio and then how to tweak these products for superior performance. And lastly, for your life insurance needs, I am currently offering a free 15-minute call. So, whether you're someone who needs consultation on the best policy type, I specialize in term policies and policies that are designed to build wealth. Welcome back to another episode of Well Positioned. This is your host, Kyrie Graves, back with another video. Now, on this video, we're going to talk about a play that Wall Street loves to do time after time: buy the rumor, sell the news. Sometimes you'll see it kind of played out in more of a sell the news, buy the rumor, vice versa. But the whole concept behind buy the rumor, sell the news really stems from an understanding of what do markets care about the most at this very moment. One of the ways you can kind of do that is by looking back in time and seeing, okay, what was the most recent volatile event that took place, right? Something that caused a big, sharp decline in markets in a short period of time. And what was the narrative at that time? What was the piece of economic data that came out that kind of pushed, market participants away from buying and turned them into sellers? You can also do that on the reverse side if you look at a big momentum move that pushed stocks, higher, kind of figure out, okay, what was the cause or piece of news that, allowed stocks to rally so hard. So once you have that kind of understanding of, okay, what took place in the past, and is that the most recent thing that markets care about, how does that play into price action today? The reason why Wall Street loves this type of play is because it's a bit nuanced, and it can go a bit undetected in many ways. And what do I mean by that is, like, you can have a lot of headlines that come in from the news and from the mainstream channels. And these headlines will portray different narratives of why stocks are going up or down or staying flat, or why they are doing certain things. That's kind of good to know, but that doesn't really paint the picture of what Wall Street, or what, and when I say Wall Street, I'm really speaking about people who move large amounts of capital in and out of the market and are consistently profitable and consistently able to extract money from the stock market. And we want to be on those side of traders. We want to be on those side of investors, those who are able to consistently have an understanding of what the market cares about and how to make a profitable play out of that. How do we pull money from understanding what's going on? And the main thing, in order for us to do that, like I said, we have to look back in time and figure out what took place, right? What took place that caused the volatile event, and then what do we care about right now? And we're going to look into the charts and actually kind of get a breakdown of like what the current rumor is at this moment. And first we have to kind of build somewhat of a story or theme or narrative that makes the most sense, so that we have an understanding of what we're walking ourselves into. So
When we talk about the rumor, let's break down what the rumor is or what a rumor could be. A rumor could be, the idea or the notion that something is going to take place that may change some of the structural inputs that markets rely on to move price. So, for instance, that could be interest rate cuts, that can be earnings from a really big company, that can be some type of government policy getting ready to be signed into law that may change how funds or resources are directed in a certain way. That could be a new tax law, it could be a new president or a person in power, maybe a new CEO of a company. So to buy the rumor, sell the news play can kind of play out in individual stocks, and it also can play out in the broader market. And when it plays out in the broader market, we want to actually rely on some macro type of data or a macro understanding to really get, you know, inside the mind of the market and figure out what the market cares about. The beauty of this play is that we watch this actually play out constantly, time and time again, because throughout the seasons and throughout the quarters, right? Every, couple of weeks or a couple of months, the market cares about different things at different times. And the market kind of has a way of putting blinders on and getting focused on the main thing that can cause prices to go up or down in stocks. And it's not that it causes prices to go up or down in stocks, but it's more so the impact that this event will have that will cause a negative or positive impact to markets. So that's really where the whole rumor part comes in, is like, okay, we have an event that's on the calendar that's coming up. We can, foresee, for instance, a Federal Reserve speech that is coming up in on a Thursday or a Wednesday, right? Could be a few days away. So as we're leading up to that, the market may start to position themselves in a way that allows them to participate in an upside or downside based on what they think the outcome of that event will be. So, for instance, if a Fed speech is coming up, the markets may rally the days leading into a Fed speech. And once the Fed starts speaking, whether he says something positive or negative, stocks may just sell as soon as he starts talking. Well, why? Because they were buying the rumor and then they sold the news. Now, sometimes what can happen is the news may come out and the news may actually be different than what the market positioned itself for. And so let's say Wall Street is buying as they ease into or get closer to a Fed speech day. And then the Fed starts speaking and he says, "Oh, we're cutting interest rates 2%." And all of a sudden the market's like, "Whoa, we weren't positioned for that. We didn't see that coming." It's almost like a black swan event, if you will, because this is a piece of information that wasn't anticipated, and it wasn't priced into the market. We didn't position ourselves for it, right? That's what the investors are saying. So what happens? They bought into the meeting, and now they have to continue to buy off of that news, and now you create this huge market, buying imbalance that takes place based off of news that investors or Wall Street wasn't positioned for. So that's kind of how the market likes to move. The market likes to move in ways that it think things may go, and it likes to price in what is known as it leads up to what can change that known piece of information, if you will. It gets a little nuanced, but it helps to try to make sense of it and follow the narrative of what's going on for yourself, and not necessarily rely on the news headlines or things like that to kind of tell you what the narrative is. So let's dive into a chart, and I want to speak about what does the current buy the rumor sell the news situation look like in the markets. Okay, so if you're looking at my screen here, I got a chart of the S&P 500 pulled up. I'm using stockcharts.com only because my trading platform is actually under maintenance right now. So I'm not able to kind of use my typical trading platform as I do or as I have been in past videos to kind of break down, some of the things I'm talking about. But just bear with me. We're going to do the best we can. So buy the rumor, sell the news, man. Very, very profitable Wall Street strategy if you can, tap into the understanding. So we're going to kind of walk through we're going to kind of walk through the market narrative of like how we got to where we are right now and try to identify some of the things that the market cares about. Um, Now, if you will, right? So we have to kind of look back to a volatile event, and I would say that the event that stands out most to me would be this kind of V bottom action here that really took markets off to the upside, right? We kind of came out of 2022, we had a bear market going into 2023. Things were getting kind of, it started out pretty positive, in the middle of last year, and then things got negative again. And it wasn't until the last day of October where the market really did a reversal and just kind of took off ever since then. And what happened there, right? So let's go back. At this time, Jerome Powell, the Federal Reserve Chairman, gave a speech saying that they are done their rate hiking cycle and are looking to cut rates at some point in the future when the inflation reports comes that are coming out gets a little bit more positive, right? So they're done hiking, they're done raising rates, they are done making the cost of capital more expensive, and it wants to reduce the cost of capital at a point in time where the inflation data becomes favorable. Okay, so fair enough. So that was the narrative here at this October bottom. So the markets kind of rallied and took off. Now, mind you, the markets were really rallying because on the backdrop of this, we started getting positive earning reports, really positive earning reports. We got, I think, this big candle move was Nvidia reported its Q4 of 2023 earnings report, and it just really reiterated how strong the demand was for this AI infrastructure and this kind of new industrial, movement of profits getting ready to take place in all of these big tech companies with the AI and these data centers and things like that. So the market really had a lot of tailwinds, a lot of wind at its back that was allowing it to just go higher and higher and higher. It had the Fed on its side. It had a strong economy as its foundation. And, things couldn't get much better than the way the market was at the start of 2024. Right. And I was reiterating that in some of my past videos of like, you can't ignore that. Plus, on top of that, you had this government spending that was taking place, right? We've seen a records amount of government spending taking place quarter over quarter. And on top of that, we've seen a mass increase in immigration, right? So that's more demand entering the country. Corporate balance sheets were looking incredible. Like there was so many different factors that was just so bullish for the stock market going into this year. And I'm actually surprised that the market didn't take off even more than it did, right? That's why I'm still bullish. But as we get into this correction here that took place in the beginning of April, and I don't even know if you can call this a correction, it didn't even make it down 10%, which kind of shows you how bullish and how much demand there is for stocks and for equities because it didn't even make it down 10%. I think this was like less than a 6 or 7% pullback. And as I said in my last video, one of my last videos, I was talking about, is this a bounce or is this a bottom? And I kind of reiterated and showed some of the market signals that was confirming for me that this was a bottom. I mean, we had so many things going for us, and around this time some of those things, right, started to deteriorate just a little bit. What started to deteriorate? One, we started getting inflation reports along the way that was not favorable, right? We started to see that inflation was still hot. It hasn't cooled down the way the Fed wanted to see to give it comfort to cut interest rates, right? So the interest rate momentum was starting to get removed off of the table. And unfortunately, that was kind of one jab to the stock market rally that the market had to deal with, right? Basically removing the hope of interest rate cuts off of the table. On top of that, we started to get some not very much, but some negative growth data and data reports that came in, some less than favorable GDP reports and things like that. And then around this time, toward the bottom, we got some negative or unfavorable job reports, right? that was saying that the rate of hiring in the United States was starting to decrease. So as we were putting all of those things together, well, yes, those are negative things, but how does the market actually view that? Because the market didn't get an inflation report that it liked, right? It got some growth, it got some growth reports that it quote unquote liked, in the sense that it would give the Fed some cover to cut interest rates, because if growth is slowing, the market is anticipating, well, that means inflation is on its way to slow down, right? If the demand side is starting to decline, then the price side should eventually catch up to the demand side. And that's what the market is hoping for. That is kind of the rumor right now, that yeah, we got a hot inflation report. I think it was around this time, somewhere as the market was trying to bottom and balance itself out. And the market, in my opinion, is hoping that it the market is hoping that most recent inflation report was one of the last high inflation reports, or one of the last hot inflation reports. So it's kind of going off of hope at this point, right? So this market rally, though I do think this is a bottom and I think it can continue higher, I think the market will actually make a new high before the next inflation report comes out. And then once it's in this like no man's land territory, maybe somewhere up here, right up at a new all-time high, it'll let the next inflation report decide where it should go from there. And I say that to say, because we actually get an inflation report. Um, Now, before we look at when the next inflation report is, I was going through some of the past data in April. Yeah, so we're looking at here, Friday, May 3rd, we had a non-farm payroll number that came out. Forecasted was, they were hoping 238,000 jobs created, and you only got 175. So boom, that was one of the first, or not one of the first, but that was a big report that came out that basically said, hey, the growth demand side, where right, the job creation and the spending and how the consumer and the employee is faring out, is actually starting to deteriorate. We were kind of really ramping up. Everyone that had a job or wanted a job had a job. Now we're getting to a point where that is, we're not growing as much as we thought it would. So that kind of sets up a play. We'll say, hey, if that's the case, then maybe inflation is also doing the same. Inflation was ramping up higher, and the growth rate was increasing. Now maybe it can start to go down. Maybe we have seen the peak, but only time will tell, right? So we have to look. So if we want to look forward, looking ahead to when the next inflation report comes out, we're looking at Wednesday, May 15th. So that's, this coming week. And we'll see what happens. I mean, we got retail sales, we got inflation year over year, month over month, core inflation. This core inflation is one of the big indicators that the Federal Reserve looks at. So we're forecasting a 0.3%. Previous was 0.4. Let's say we get a 0.2 or a 0.1. Man, we could see markets not only hitting all-time highs, but going much higher. Why? Because that sets up a play for the market to say, hey, inflation is starting to tick down, right?
And I want to speak on something.
Really quickly. And one of the things I've come to conceptualize about the stock market is that the stock market does not mind inflation. The stock market doesn't even mind high inflation or higher inflation. What the stock market cares about most when it comes to inflation is that the stock market wants to make sure that it is not the cause of inflation. And oftentimes the market will sell off if it ever feels that the driver of inflation, or what's keeping inflation high, is because stock prices are high. See, stock prices loves to be high when inflation is low, because that just sets up a lot of great things. That means that the cost of capital is relatively low, and that cost of capital is allowing companies to invest in themselves to continue to grow. But if the market ever feels that those who own a 401k or an investors or things like that, have it a little bit too easy and is trying to race inflation to the top. That's not how markets want to perform. We've seen that in emerging markets and some of these economies that are not as robust as ours, right? Zimbabwe, Argentina. We've seen stock markets that go to the moon as inflation is going to the moon. And that's what you call a broken economy. And I think we can determine, one of the ways we can determine if our economy is starting to break is if we see inflation out of control, going higher and higher and higher, and the stock market is just racing along with it. See, the stock market knows inherently that if the stock market was to get cut by 50% today, inflation would no longer be a problem tomorrow. And I truly mean that, because if you if you get rid of that much wealth in a short period of time, right? Let's say the market crashes 30, 40, 50%. You think people are going to be quick to run out to buy and spend money? And no, they're going to find ways to kind of pull back and bring their cards a little bit closer to their chest and say, hey, maybe I won't buy that new car. Maybe I won't put that addition in my house. And all these trickle down things may start happening to the point where, companies with these high price tags may say, all right, I have to cut some of my workforce and I also have to cut some of my prices. And when I cut those prices, that may then reattract the consumers to come back in and say, hey, I was selling this car for 50,000, now it's 30,000. And the consumer may say, you know what, I can afford that, right? Because I just got my wealth cut by 30, 40%. I'm not paying 50,000 for a car, but I'll pay 30. So that's kind of how the economy can regulate itself. And the stock market inherently knows it has the power to do that. I'll give you an example. Okay, so for example, let's look back at the beginning of 2022. So the beginning of 2022, we had, from 2021 leading up to 2022, we all know what happened in 2020, right? And we all know the response that the government from the Federal Reserve and the fiscal spending, we all know the impact that had on the economy. There was a lot of money thrown at this problem. All of that money forced a lot of prices to increase very quickly. And one of those prices that increased very quickly was stock prices. Stock prices was actually just taken off before. Think about it. Stocks and the price of stocks took off before the price of all these goods and services. So when that happened, we started to see the stock market found itself in a situation where, it's like the emperor has no clothes on, right? The stock market looked around and said, oh crap, I came way too high, way too fast. And once the Federal Reserve said, hey, party's over, no more of this money, throwing all this free money around, we're actually going to start raising rates and we're going to try to bring inflation down, as strongly and as quickly as possible. So the market was like, all right, I got to go down too then, because now I'm also contributing to, inflation being higher. The market knew that. The market knew it was too high and it got too high too fast. So what did it do? To slowly over time just kill demand and kill demand and kill demand, kill some of those animal spirits, kill some of the irrational exuberance, and try to help the Federal Reserve get to where it was trying to go with inflation. And the market knew it had the power to do that. And it would have continued selling off if it felt like it wasn't doing its job, or if if prices needed to come down more. But the aggressiveness of how quickly the Fed raised interest rates, the market knew, okay, it can kind of dip into a bear market, and then tried to rally again in 2023 and eventually found some footing. And now we find ourselves where we are now. So in many cases, the stock market felt like it did what it had to do to make sure that it's saying, hey, I'm not the one causing inflation. I'm not the one perpetuating inflation. Don't look at me. You know what I mean? The market is saying, hey, don't look at me. I'm not the culprit here. And as long as the market feels like it's not the cause of inflation, the market would love to continue to go up. And that's pretty much all I have for you. So, you know, keep an eye out for that data report on May 15th, that inflation report. It's actually way more important than, the headlines and the news and all that stuff is giving it credit for. It's actually extremely important. Um, I think if you get another hot inflation report, you can see the market probably start to go lower, maybe take out its lows from that most recent little dip it had. Um, and like I said, the market will go down until it feels as though it's killed enough demand and killed enough animal spirits to bring inflation down. If it has to, it will. The market is not afraid to do that. And as market participants, we have to be very unemotional about that understanding. Do we think markets are going to go higher over the long term? Oh, for sure. But, you know, if you can kind of see some of the signals and some of the signs coming that, hey, it might be a good time to, at minimum, not add money, right? So maybe we don't want to sell and get out of the market. Maybe we don't want to be, be short sellers and try to bet against the market. Maybe don't want to be that sophisticated. But if we can at least tweak and perfect the when to buy process. I mean, think about how great your returns will be if you just know when to buy. And that's kind of what I try to, do most. I try to get a little savvy with short selling and things like that, but for the most part, just knowing when to buy and when not to buy is a way to make great returns and have a very confident approach to putting money to work in the financial markets. So that's all I have for you. It's been a pleasure. Till next time. Thank you.